Today we're going to be talking about how you can invest in the stock market and a diversified portfolio overall. We're going to look at the impact of getting out of the market, getting back into the market, stopping, starting, trying to time, and probably the number one value that most wealth managers or investment advisors bring to their clients, and that is endurance and not letting emotions drive the day when it comes to investing. So let's go ahead and jump right on in. All right, let's get right in here. As you can see, we're looking at the importance of investing for the long term. And really want to just look here. You can see, first of all, US stocks have done about 8% per year since 1994. And I really think the figure's higher if we go back even further. This is just a look at the long term here. And you can see how $100,000 would grow. And then as we look here at the odds of cash underperforming are very high. A lot of people don't know this, but even if you have stocks versus cash, all the previous 5 years since 1940. So this one goes back quite a long period of time, 84 years. And over all those 5-year periods, cash only outperformed the stock market 20% of the time. And as you go to 6 years, it jumps to 85%. As you go to 7 years, stocks outperformed cash over rolling 7-year periods 90% of the time, which is really surprising, I think, for a lot of people. A lot of people will pull their cash and they'll sit on the sidelines for so long. And then as you go to 15 years, you're pretty much, stocks have almost always outperformed cash on any 15-year time period. Now what I want to do is just pause here and then jump in and let's look and see what the rolling period average is when we look at a portfolio with gold. Hi, my name is Tommy Cloud. I'm president of Third Act Retirement Planning, and we help people all over the country to achieve peace of mind through wise wealth management principles. If you'd like to subscribe to our channel, go ahead and click and subscribe. And we'd also love to hear any comments you have about how you design your portfolio. Or if you can take advantage of a free 20-minute call and meeting with me via a video where I can look at your portfolio and we can see what's working well and what's not. You don't know what you don't know. And to have the humility to understand that the main thing that all these studies found that financial advisors bring investors just like you is the ability to stay the course and not panic when the markets get rocky. And now back to our content. All right, this is a portfolio that's 34% the entire US stock market, 33% the US total bond market, and then 33% gold. As you can see, and by the way, this portfolio goes back to 1987. And so here we are now at the end of 2025, and it does give us a pretty good history there of about 38 years, we'll call it. But you can see here during the financial crisis from March of 08 to October of 2008, this type of portfolio, that was an 8-month time period, went down quite a bit, 19%. But that's really not that much when you consider that stocks that year went down 37%, the S&P 500. And then you think about the fact that gold went down like 50 or 60% in 1981. So 19% is not that big of a deal. And then its second worst period was January of 2022 to September of 2022. That was only 9 months long. And had you had this portfolio, you would have only been underwater for 2 years. And it was down 16.54%. So as you can see, as we look at the worst drawdowns over the past 38 years in a portfolio that was a third the US total stock market, a third the US total bond market, and a third in gold, you really only had 2 time periods where you were down more than 10%, a drawdown more than 10%, all in 38 years. And you were back to break even in 2 years or less every single time. That is a pretty stable portfolio, simply using the biblical principle that the trillionaire King Solomon wrote out for us through God's inspiration in Ecclesiastes 11:2, just by diversifying. It's not that fancy. It's not that complicated. It's just something you have to do. Really, it reminds me of going to the gym. If you overthink it or you start making excuses, all this confusion that we have in life, most of it, comes not from Jesus, but from the devil, his great enemy. Diversify your assets 7 or 8 ways because you don't know what danger may fall upon the earth. Depending on how you interpret that, it doesn't mean I'm going to buy Microsoft, I'm going to buy Dell, I'm going to buy all these different US stocks, because that's not true asset class diversification into non-correlated investments. So now what I want to do is show you the rolling period returns with this same exact portfolio. Okay, so we just looked at a portfolio that had stocks and bonds in the usual standard split that Wall Street is so promoting and pushing. And now we're going to look at a portfolio with US stocks, US bonds, and gold. A portfolio that we don't see pushed as much. Although the banks or central banks are happy to buy a bunch of gold, they don't want to encourage us to buy it for some reason. And I'm not saying gold's better than stocks because I don't think it is. I'm not saying gold's better than real estate because I do not believe that it is. I'm just showing you a portfolio by adding gold. There's other things we can add to this as well. Utility stocks, coin. So there's other good investments we can add in here, in addition to certain types of fund, like market neutral funds or hedge fund strategies that we can add, even mutual funds that have their own hedge fund strategies but are open to the public. But we're not going to do those. We're just going to keep it simple here, and that was my main point. But if you look at the rolling period returns here, you can see the average, whether you take 1 year, 15 years. And by the way, this one here is going back to 1987 again. So 1987 through the end of 2025, towards the end of 2025, December of 2025, you can see the average is always over 7. It's always under 8, very consistent. And you can see there has never been a rolling 5-year period that was a loss for this portfolio. So that's pretty powerful when you consider there's never been a 5-year period. 100% of the time, this portfolio has outperformed cash. You can't say that about those stock and bond only portfolios that I was looking at with you earlier.